Most beginners in Canada know they should invest in ETFs, but then they discover there are thousands of ETFs to choose from. Some track the exact same index, some pay dividends differently, some are hedged, some are tax optimized, and suddenly investing feels overwhelming again. In this video, I'm going to show you the easiest way to start investing with ETFs, how investors eventually move into more advanced portfolios, and how to actually compare ETFs properly. So first off, what is an ETF? Well, an ETF is an exchange traded fund. It is a basket of investments, and the easiest way to do this is to show you an ETF on the screen here. So we have one of the foundation ETFs, which you probably hear a lot in the news, and S&P 500. The S&P 500 is up or down, and you hear that a lot. And so what this is it's basically 500 companies. And if we go down to the portfolio, we can see down here, we've got NVIDIA, we've got Apple, we've got Microsoft, Amazon, Alphabet. And these are the largest companies currently right now that are in the States. So 500 of the largest companies. Now this allocation is all weighted based on how large the company is. And so the whole idea is those 500 companies are going to be broken down to, if it's a larger company, they're going to have more money invested in it. If it's a smaller company, they're going to have less. So NVIDIA obviously has the market share right now. They're the number one. And you can see that they're owning that percentage of the stock along with the others. And you can actually go down through all 500. And as companies grow and shrink, they're going to lower their percentage or they're going to increase their percentage based on that. So this is basically what an ETF is. It's that basket, right? It's a benefit. There's a benefit to having it, like being able to be diversified, right? It's easier than stock picking. It's meant for passive investors. All of these things contribute to what an ETF is. I'm pretty sure you probably have heard a lot of the basics around ETFs, so I'm not going to get into that per se. I'm going to actually go a little bit more into some of the nuances and the challenges that typically fall for an investor when they're actually trying to figure out what to do, how to invest in ETFs, common traps or snares that they have as they're kind of going down this pathway of finding ETFs. So why are ETFs so popular? Well, for those of you guys that are interested in that, they have been accumulating more and more data showing that against actively managed funds, index investing essentially has been outperforming the market. So 98.82% of the time, it's outperforming active investors. And this is for Canada. Obviously, that's where I'm from. But even if you went to something like the States, which has a bit more data over the 15 years, you can see that it's still outperforming. And so, those are some of the basic reasons why. Also, you factor in diversification, lower cost, simplicity, all of that. It just really begs the question, why are we trying so hard when we can accumulate larger pockets of wealth without having to put in more effort? So anyways, moving on, why do beginners get stuck? What are some of the challenges that we find that beginners have when they're looking for ETFs? Well, there's a lot of challenges that they have, and let's just, I'm going to show my screen here. Again, all of these resources are going to be down in the description below. And as well, just know, this is not financial advice. If you're looking for financial advice, go talk to a financial advisor. This is simply just educational information. I am not a financial advisor. I'm not going to give financial advice ever on this channel, but I do want to bring awareness and showcase things that I believe all of us should know around investing. So we can see here that obviously the very first thing that anybody has when they're looking at ETFs is overwhelming information overload. This is probably one of the biggest pitfalls that I find talking to family, talking to friends, people that decide to get into investing and then they procrastinate, they fall off for a while and then they want to get back in. And statistics actually show that that's actually one of the major challenges with investors that do a DIY approach. So then it begs the question, how do we solve this? How do we deal with this? Well, we have to break things down into bite-sized, simplistic models of thinking so we can understand how to tackle this issue. And so, and again, I'm just looking at these ETFs. This is ETFs of Canada. If I go to ETFs of the USA, there's more. And there's thousands upon thousands. There's like over 4,000 in the States. There's, I think it's something around 15,000 globally. So you can see that there's a lot of different types of investments out there. If we go into something like VFB, or we go into any of these other types of investments, you can click into it and you can see what they are. You can see, a little description, and it kind of explains it. So this is through TradingView. You can use anything like Yahoo Finance, stuff like that. So all of these things really get beginners frustrated because it's called, that decision fatigue. And then you're delaying your investing. And then as an investor, it's hard because if you have a delayed investment, even just a poorer decision in an investment is better than having, a delayed investment where you're not able to have that compound growth, because essentially you're losing out on profitability that's already taking place right now. So this begs the question, one of the first challenges that somebody would come across with is, what is the simplest solution? Well, let me show you what some of the simplest solution is. So going back to this list, there are different types of investments. So for example, there are ones that are, they're essentially just all-in-one ETFs. So just an example of that would be this Vanguard Growth ETF portfolio. So when I click into this, you can see here that this fund is a long-term capital appreciation. The fund actively allocates 80% to equities and 20% to fixed income. Fixed income meaning bonds. And then the active, this is like your stocks. And then the fund invests in global diversified exposure. So you're gaining access to the whole market. So this is really beneficial because they're actually just, you're basically buying one ETF and it is tracking all of that for you. So let me just show you a little example here of what all these ETFs are. So these all-in-one ETFs, you can see right here, we just looked at the VGRO, so it's the 80% stocks, 20% bonds. So basically you can see that it was actually quite high on that list, and that list goes by the amount of people that have been investing into that particular investment. So like the highest to the lowest, so it's pretty high up on the list. So a lot of people are really invested in this one here in particular. But we also have a different approach and a different option. So, you could actually look for an all-in-one ETF that's more like 40% stocks and 60% bonds. And what this really is translating to, and why we're just looking at it more like this, and then you have that basket of investments, is as you have more and more bonds, your risk profile starts to go down. But when you have more and more stocks, your risk profile goes up. So if you have a longer duration of time, usually you can, stomach, and to be honest, you actually want that risk because you have the ability to have a higher return. So the compound can be greater, where a lot of times people like having more bonds when they're having to start withdrawing from those funds, like if they're in those early stages of retirement. And so that's why there's different types of investments like this. There's also target date fund type all-in-one ETFs where, it'll slowly glide from being closer to 100% stocks. And then as you get closer to retirement, it goes into more of a 60%, 60% in bonds. So there are a few different options out there. Again, going back to the investments here, if I go back to... Here we are. If we go back to this, you can see how close it is to the top. It's pretty close. We've got the VEQT here, right? So we've got the all equity one. There's basically just a plethora of different types of investment options. The other thing too to kind of think about is there's different types of investment firms, right? So like you'll have some that will, like you have Vanguard, you have BlackRock. So some of them will have, the exact same investment, but it's branded the way that they're branded. I think of it kind of like, I'm going to go and buy a pair of jeans, right? And there's lots of varieties of jeans, but at the end of the day, I'm going to buy a pair of jeans and I want to wear a pair of jeans. So essentially, it's kind of like that. Um, there's different features and different reasons why you get one over the other, and we're going to break that down a little bit here. But ultimately, one of the simplest ways to get invested is to really start with an all-in-one ETF, because if a lot of times when people don't have that time, especially for myself, when I don't have that time and I'm not able to actually figure things out, I don't want to spend time in, wanting to invest. I just simply figure out what my risk profile is, and I'm just going to basically pick one that's basically going to match up with that risk profile, and it's going to be well diversified globally. So those are beneficial. You don't have to worry about having to buy something else. They rebalance themselves. They're already diversified. They're already buying and exiting different positions as companies are growing and shrinking. And so you never really have to worry too much about figuring out which stocks you're having to pick. And so that's one of the first things that I think is really important to factor in. Like, having something is better than having nothing. Having investments and getting into a mentality of knowing how to invest is more important, I believe, than being able to say, I'm going to work out all the details, because details can get worked out over time. And so I believe that what I'm talking about here is like an investor evolution. It's basically that you evolve and you grow. So investors start simple. And one of the best ways to start simple is start in what is backed with research. Start in what is backed by, what everybody is investing in and what they're actually optimizing for, versus just, I really like my Apple phone, so I'm going to invest in Apple. That kind of stock picking is riskier, because there's a lot of risks associated with that, and not understanding how things work can really play into that. So over time, investors want more control, right? They want to lower down their MER. For those of you that are wondering what the MER is, we've got here this expense ratio. So, we've got an expense ratio of 0.24%, and that's specifically for this all equity ETF portfolio. If I went over here to this VFV, you can see that the expense ratio is 0.09. And you're probably looking at this and saying, okay, well, why is that 0.09, the other one a little bit more? Well, the other one's doing a little bit more work. It's having to be a bit more diversified and, be able to balance a lot more of the different assets that are in there. And so, there's a cost and a trade-off for that. And that's where that MER kind of kicks in. So if I was somebody who was like, you know what, I want to save that 0.1%, or I have a large enough amount of funds that it actually makes it worthwhile to, invest in, instead of having an all-in-one ETF, maybe I'll have 2 or 3. And so that tends to be the case in a lot of people. And a lot of times when they've invested in more of a traditional portfolio like this, they'll end up getting into something that's called a 3-fund portfolio. And so usually they're actually getting into something where, they're taking something like an international stock, like VXUS. They're taking like something like the VFV, the VOO, something like that. And then that's capturing the market. And then they're taking another thing like, BND, which is like the total bond market. And so then they've broken down their sections into being strictly the international, right? The states, right, being their home country, and then, having the bonds. And so then what they can do now is they can play around with those ratios. So they're able to say, okay, I want a little bit more in international, or a little bit more, I want a little bit more in bonds. And then, they're just rebalancing themselves with 3 ETFs. And so when you do those rebalancings, you're saving that slight percentage on the MER. And that tends to be, I find, a lot of the cases there, as well as there's different types of tax efficiencies that usually go along with that. So what are some things that we can actually do to evaluate, um, you know, an ETF? Well, let's just have a look here. So we can see here that, one of the ones that we just talked about was we lower our fees. So we focus on the MER. Another one is we want to look at the holdings. We kind of briefly talked about that. But, you might even, find that you can actually, instead of owning just the 500 companies, you can actually own the a larger portion. You can get into like the total stock market. So now you're getting into a little bit of mid cap and small cap when it comes to owning the market. And so you're getting a total market. You might not have as much if you're based on that allocation on size of a company. You're not going to necessarily have as much invested in the small and the mid, but you're still invested in them. And so there's a difference there. So knowing what you're holding really matters, or how much bonds you have, or how much stocks that you're having. All those different ratios matter when you're looking at ETFs, when you're looking at these baskets. Another aspect to consider is dividends. Income distribution. So, how much are we going to receive? Some stocks will pay a dividend, some won't pay a dividend. There's a thing called hedging. So you could own something, in the States or globally, but you have the investments hedged against the Canadian dollar. So what that means essentially is, like if you wanted to own something in the States, and you didn't want to have to deal with the fluctuations of the Canadian and the American dollar, well, then you can eliminate that factor by having a hedged investment, investment that way. So most people, I find, when they're investing in something like, say the S&P 500 in the States, a lot of times they just take it unhedged because they just factor in the growth of the company. And that, but there is the option to have that currency exposure, and that tends to be something that people do factor in and care about. Another one is typo here, but tax implications, how to minimize the taxes. So all of those things are basically really important. Whoa. I got a switcher here, and I'm just getting used to flipping around on it. And it's a lot of fun. So anyways, yeah, so these are some things to factor in when we're looking at different types of portfolios. And so if I go into an example, let's run an example. So if I go into let's go into Vanguard Growth or let's go into this S&P 500. This is again another S&P 500 we're looking at the VFE. We can see the MER is 0.09, right? We can look at, we know what the investments are relatively going to be. We know that, we're just comparing a couple different S&P 500 type of investments because, you're trying to find the best one. You want to find the one that's going to fit your needs. So in this case, we've got the VFE. Another option that we could have is HXS, which is another one that's invested in the S&P 500. You can see here that you can even buy it with Canadian denominated version, or you can use your US dollars. Again, all of these are unhedged. And then, we've got something like VOO. This is actually, so this one here is in Canadian currency, the VFE. This VOO is actually in American, in USD. So here's the thing. When you start getting a little bit granular and you start thinking about each of these investments, you would look at it and, maybe just read the information, but just really understanding, what the underlying principles are that are at work here. Because, you might look at something like, looking at specifically the MER, and you might say, okay, well, this one here has, a higher percentage than looking at the MER here, right? And then if I go to VOO, you can go to the you can go to the MER here, which I'm gonna find it. We're gonna find it together here, guys. Okay. Performance and fees. Okay. 0.03. I scanned over it. 0.03. So that's the lowest. And then you might be saying, oh, wow, I want the one with the very lowest MER, like, because we don't understand all the other aspects that also are factored in. But each of those perform differently, right? So like if I'm as a Canadian and I want to invest in that S&P 500, I have to factor in, okay, now I have to convert my Canadian dollars to USD in order to get into VOO to have that lower percent. So if I look at a conversion rate, say of 2% or 1%, or, there's a couple of tricks you can do to lower it even lower than that. But if I convert that over, basically now what I'm doing is I have to deal with, that fall, right? I'm going to have to deal with that fee right out the gate in order to get the savings of just a couple points. So that's where something like that VFE makes a little bit more sense. But then, you have to ask yourself the question, does it make more sense for the VFE? And when you start figuring out how taxes work and you start figuring out how, if you have an RRSP, maybe not all the other accounts, but in an RRSP, when those dividends are being paid out, that you can actually save a bit on tax by holding, the VOO in the RRSP. And so now you have a tax advantage there. So now you're actually probably going to potentially buy, if you're looking at this option, maybe VOO in your RRSPs, but then in all of your other accounts, you might be looking at the VFV because you're actually going to have a long-term, you're going to have a little bit more profit that way. And then, when I was showing the HXS, what is that one all about? Well, those dividends are actually reinvested back into, right into the stock. So you're essentially keeping your dividends within the basket. And so now you're not triggering taxable events. So if I had a taxable account, right, like a non-registered account and just like a regular account, I might want to hold the HXS. And even though it had the highest fee, it's probably a lot better because those dividends are not going to be charged to me or as income when I go to file taxes. Again, not a tax professional, you have to do your due diligence there. I'm just trying to give you some little nuances to factor in. And then you might be saying, well, this is overwhelming again, I want to quit. But then at the same time, if you have nothing, it's worse. So that's why having something where you start off with something like an all-in-one ETF is an easier approach. And then as time progresses, you can say, okay, I want to take the same portfolio, but I want to minimize my expenditures. So I'm going to just do that alone. And then you might even get to a point where instead of just minimizing your expenses, you might say, hey, you know what? I'm going to start diversifying a little bit different. I'm going to start seeing what other people are doing. Like we have the famous investor, Warren Buffett, right? Where he has grown Berkshire Hathaway's, and his takeaway is simplicity matters. And he's heavy on the S&P 500, so he's going to take 90% of his investments invested in the S&P 500, and then he's going to take the other 10% of his investments and he's going to put them in short-term bills. And there's an ETF called BIL, so that's another type of investment. So if you take just those two ETFs in particular, now you've got the Warren Buffett type of portfolio. And that's a long-term investing portfolio. And then, you factor in having, a different version of the S&P 500 in the various types of tax savings accounts you have. Now you have a Warren Buffett portfolio that has tax efficiencies built in, that has factoring in your MERs and stuff like that. And so that tends to be the reason why people start veering into other types of ETFs. And just like jeans, right? Somebody is paying attention to the little buttons on the jeans and they like, the pockets a certain size and all of that. It's the same kind of thing with these ETFs. You might be getting relatively the same thing and relatively not much of a difference in performance, but you're having a little bit of slight differences. And so really the whole thing that I'm trying to get at here, and what I'm trying to wrap this up as is that there's no perfect portfolio. So the thing is that consistency matters more. Staying invested matters. Simplicity often wins, right? Start before you feel ready. All of those things matter a lot. Again, just financial education, not trying to be financial advice. Do your due diligence, do your homework, and I'm looking forward to chat with you guys in the next video. If you like this video, please leave a like down below, subscribe to the channel. And if you're wanting to join in with all of the things that we're doing here at Good Fruit Investors, check out the link down below to get connected to our community where you can jump in and be engaged with like-minded individuals. We like to have live discussions and a little forum that we can talk in. And looking forward to see you guys in the next video.